The Reserve Bank is widely expected to cut the official cash rate to a new record low this afternoon. For more, I'm joined by Sky News business reporter Chris Kohler. Chris, what can we expect?
Yes, well, all eyes are certainly on the RBA today, but look, the markets are officially open, we should say that. The market's ticking just 0.2% higher. That follows yesterday's 1.2% fall. That was the worst day on the market in 5 months. So certainly everything seems to be pretty much baked in as far as the RBA is concerned. We'll keep you updated as to what the market does today. But certainly, as I said, all eyes on the Reserve Bank. I'm joined by Matt Hassan, now senior economist at Westpac. Matt, thanks very much for joining me.
Good.
Now, Westpac has actually got 3 rate cuts set in what their expectations are for the second half of this year. Why so many?
Look, we think the RBA needs to get on the front foot with policy. We are already seeing a clear slowdown in growth. We think many of the negatives affecting growth domestically are going to extend throughout this year and next. And we see a weaker labour market outlook. The RBA has pretty much flagged already that that policy would need to be eased more than once. Their own forecasts embedded were conditioned on rates falling 50 basis points. We think they'll need to go slightly further to ensure that the labour market is back on track. They've said pretty clearly that it's not good enough just to have an unemployment rate that's steady. They need it to decline. On our forecast, we think we'll be about 0.5% higher on the unemployment rate by the year end. So they'll need to go a little bit further with policy to bring the labour market back on track to achieve their medium to longer term goals around inflation targets.
Right, and so of course with the market agreeing with Westpac that something like three cuts is likely over the next 12 months, do you expect much in the way of reaction today to a cut?
So, look, there'll be a little bit of reaction. I know it's 100% price from the market, and I think 40 out of 40 economists are also forecasting a move today. I think the market will really be keying off the Governor's decision statement. So far we've had, the Governor's speeches which have outlined the shift in view, but the decision statement will really give a better sense of the urgency or determination that the bank now has to get back on the front foot with policy. So I think the market reaction will really come off the basis of that commentary. There will be some reaction to the fact that it's been delivered. It's been a long time between drinks on rate cuts. Over 1,000 days, I think, since the last move. So a lot of the market's been waiting a long time. I think where there'll be most interest down the track, probably not for today, is whether the bank starts to discuss other options around policy. We're getting to the limits to which interest rate changes can effectively drive stimulus in the wider economy, and that's the focus.
That's one of the most interesting things around Westpac's commentary, is that there is, in this sense, a kind of a bottom as to how far cutting can go. And look, if we do see a cash rate of 75 basis points, I mean, what happens next? Emergency measures, quantitative easing?
So I think that's where the bank will need to look next. It's probably premature to start discussing those things now. At the moment we still have some scope with interest rate policy, and I guess the question from the point of view of the market is, what's the approach to this policy? Is it just an extension of interest rate policy, business as usual, or is it something that's more along the lines of smash glass in case of emergency? Yes. Do we have to wait for the real emergency moment for the bank to go down that path? And so that's what I mean by the language that the RBA uses, and then in discussing these other potential policy avenues down the track. We think it's a bit premature for this year. They still count on interest rates passing through to market rates, and of course a currency effect. What may complicate things for the bank is that market pricing around the Fed has shifted pretty starkly over the last month, and so they may get less support from the currency channel than they were anticipating maybe a month or two ago. So I think that the commentary around that will be very important.
Yeah, the Fed certainly changing things for the Aussie dollar. Just on that expectation and the reaction to today's statement, with 74 basis points of cuts priced in for the market over the next 12 months, do you think that it's quite possible that it will not be as dovish as the market wants, and there could be a bit of a tantrum?
Possibly. I think at the moment, the market will probably hold off in making that assessment. I think, we'll look to see how much traction the move gets. So for me, I think the keys beyond today will be, how does consumer sentiment respond to this move and the other accumulated changes over the last month, and whether that move sticks. So I think I don't think the market itself will be throwing any tantrums today unless we get something really out of the box. Something that was sort of along the lines of this is a one-off measure, we may retrace in the future, which I don't think anyone's really expecting.
So, Matt, just in terms of, obviously 1.5% is already a record low level, 0.75%, where we may end up by the end of the year, according to Westpac, would obviously be a new record low level. Can you talk to us a little bit about what that means for different pockets of the market, mortgage holders, savers, different groups?
So, of course, the major beneficiaries here are mortgage holders. To the extent that the rates flow through to mortgage rates, that's an instant cash flow injection for the mortgage belt. The negative is for those who rely on deposits in particular and interest-bearing assets, where there'll be some shaving off. So there are positives and negatives. It does have a mixed impact on different parts of the market. What we tend to see historically, though, sentiment-wise, it's viewed as a positive, particularly around the housing market. So if you look at previous cycles, the first move in a rate cut cycle generates about a 5-6 point bounce in consumer confidence on its own. Sometimes that doesn't stick that well, depending on what else is happening in the economy. If we've got the GFC or some other thing going on. Where it has a more sustained impact is around attitudes around housing. So time to buy gets a sustained rise of about 6 points over a couple of months. And that's for every rate move, not just the first rate move in a cycle. And eventually we start to see some lift. And so I think in terms of the sectoral impacts, the big, aside from the mortgage belt, it's obviously the housing market which stands to see some improvement off the basis of rate cuts, especially if we get a series of moves.
Yeah, absolutely. And look, as we say, 25 basis point cut today, completely priced in. This is a big deal, 1,000 days, 33 months, however you want to look at it. Matt Hassan from Westpac, thank you very much for joining us.